Right, let's get straight into it. Welcome to today's Explainer. Look, today we are stripping away all the retail noise and adopting a very specific, highly focused lens. We're stepping into the role of a Tier 1 investment bank chief macroeconomist to deliver a strict, binary, and ruthlessly analytical breakdown of the market. The date is August 12, 2026. We are not here to guess, we are here to synthesize hard data from the Fed, the Bureau of Labor Statistics, and institutional flows to determine exactly how today's metrics are rewriting global asset pricing models. If you are managing capital right now, this is the structural reality you're facing. So we immediately need to anchor our entire analysis on today's core data point, 3.4%. That is the newly printed U.S. Headline Consumer Price Index year-over-year figure for July 2026. Now, in a vacuum, this number might look like just a simple continuation of a cooling trend, down 0.1% from June's 3.5%. But institutional markets don't operate in a vacuum. This 3.4% print is the absolute gravitational center of our pricing models today. Why? Because it sits right at the intersection of conflicting global forces, a cooling domestic economy, and massive geopolitical supply shocks. How capital reacts to this specific percentage is literally going to dictate the rotation of billions of dollars over the coming weeks.
To dissect all of this, we'll use a top-down institutional matrix. We'll cover macro sentiment, capital liquidity, equity microstructure, sector rotation, our strategic action plan, and finally, our final verdict.
Starting off with Section 1, Macro Sentiment and Foundation. The overarching narrative driving the market today is a violent tug-of-war. When we cross-validate the CPI internals, you have to notice the profound divergence hiding just beneath the headline. Core CPI, so stripping out food and energy, rose just 0.2%, and that brings the year-over-year rate down to 2.5%. That's the lowest since early 2021. Shelter is also softening to 3.2%. But look at the energy line. Yes, it dropped 1.5% for the month, but it remains a staggering 14.7% higher year-over-year. This is the direct mathematical consequence of the ongoing geopolitical conflict with Iran. Much like the stagflationary pressures of the 1970s, the market is looking at a structurally sound core economy that is just being heavily distorted by a massive external energy shock. And honestly, this distortion is completely fracturing Wall Street's consensus. While some of the market is breathing a sigh of relief over the 2.5% core CPI, Bank of America Securities is issuing a really stark hawkish warning. Aditya Bave, their head of U.S. economics, noted that with unemployment actually down and inflation technically further from the target than it was a year ago, the Fed's previous 75 basis points of cuts were basically a hedge against a labor downside that just hasn't materialized. So the crucial point is this. BofA is projecting the Fed might actually need to execute 3 rate hikes to reverse those premature cuts. That presents a massive asymmetric risk for bond markets and rate-sensitive assets.
Moving down the funnel to Section 2, capital, liquidity, and treasury dynamics.
When macro uncertainty spikes, we don't just see prices drop. We see liquidity aggressively drain from the absolute furthest end of the risk curve. This dynamic is perfectly illustrated right now in crypto. Earlier in the month, institutional ETF flows were a solid positive signal. But look at the structural break right before the CPI print. On August 10th, we saw massive withdrawals. I'm talking $145 million in net outflows from U.S. spot Bitcoin ETFs and $14.6 million completely drained from Ethereum funds. Bitcoin struggling around the $64,000 mark isn't just retail panic. It's calculated institutional de-risking. When the market fears tighter policy, liquidity just vanishes from these highly sensitive assets as traders position themselves defensively ahead of the data.
All right, shifting gears to Section 3, equity market microstructure.
So, if capital is fleeing rate-sensitive assets, where exactly is it going? Traditional market correlations are completely breaking down, and they're being insulated by an unprecedented concentration of capital expenditure. Focus on this number, $104 billion. That is the Q2 backlog for just one single company, CoreWeave, a major provider of AI cloud computing. And get this, that figure doesn't even include the additional $25 billion in new customer commitments they just signed in early Q3. This proves beyond a shadow of a doubt that institutional investment into AI infrastructure is completely ring-fenced from macroeconomic noise. The world is short on compute, GPU pricing just continues to rise, and these companies are securing long-term contracts regardless of what the Fed actually decides to do next month. And we can cross-validate this demand shock universally across the hardware and neocloud ecosystem. Supermicrocomputer just reported a staggering $60 billion in new orders for a single quarter. Nebius Group, a European cloud provider, saw a 514% jump in cloud sales. These aren't just your standard earnings beats, okay? They are structural shifts in capital allocation. Order visibility for these firms is stretching way out into 2027 and 2028. Unlike the hollow valuations we saw in the 2000s dot-com bubble, this is the true alpha generation engine of the current market. Yes, it's heavily funded by borrowed money, but it is rigorously justified by off-the-charts operating margins and concrete backlogs. Let's translate that into Section 4, sector rotation and alpha hunting. When you juxtapose that liquidity drain in risk assets against those $100 billion tech backlogs, you get the exact blueprint for today's violent sector rotation. The smart money is executing a very, very clear trade right now. The laggards are the rate-dependent assets. Without the promise of easy money, capital is bleeding out of crypto tokens and highly speculative growth. On the other hand, the leaders are AI infrastructure and photonics. Take Lumentum, for example, a maker of optical equipment. They're up 150% year-to-date, just riding the massive wave of data center buildouts. Capital is fleeing the uncertainty of the Fed's next move and aggressively rotating into the guaranteed long-term secular growth of artificial intelligence hardware. But tech absolutely isn't the only place to hide. We also have to look at alternative signals in the commodities market. Citi just issued a striking $90 price target for silver. Why? Because underneath all this macro noise, the silver market is facing a massive structural supply deficit of 46.3 million ounces. This physical shortage means silver's pricing is increasingly resilient to a hawkish Fed pivot or surging US dollar index. It's a prime target for institutional investment demand taking over, and it offers a completely different kind of insulation from all this CPI volatility. So, what do we do with this? Section 5, Strategic Action Plan. Analysis without application is really just academic theory. Based on today's data, we've got two distinct models to plan for. Scenario A is our bullish case. If the core CPI confirms a lasting disinflationary trend at 2.5%, and the Fed chooses to basically ignore those geopolitical energy spikes, liquidity conditions will stabilize. Under this specific scenario, the massive capital currently bottlenecked in AI infrastructure will start to broaden out to the wider market. This is the exact setup that supports JP Morgan's really aggressive year-end target of 8,000 for the S&P 500, which is backed by resilient corporate earnings and massive productivity gains from AI. Conversely, scenario B is our bearish case, and this one requires strict risk management. If that 14.7% energy inflation bleeds back into core goods, the Fed will be forced to execute Bank of America's projected rate hikes. If that happens, the tight liquidity and ETF outflows we just witnessed in the crypto markets will basically act as a contagion. It will violently infect the broader equity market, totally crushing any asset that relies on cheap debt or high future multiples. Risk parity strategies will be forced into rapid rebalancing, and that will severely accelerate the downside. Which brings us to Section 6. The final verdict. We've parsed the macro foundation, we've tracked the liquidity, and we've measured the AI microstructure. So here is the immediate portfolio adjustment directive for August 12, 2026. Overweight AI infrastructure and servers, so companies like Supermicro and CoreWeave, because their backlogs provide genuine immunity to rate chatter. Overweight silver and alternative commodities to capitalize on those physical supply deficits. You need to downgrade crypto to neutral. Seriously, do not try to catch a falling knife until we see a confirmed post-CPI ETF flow reversal and a return of actual global liquidity. And finally, you must aggressively hedge using the energy sector to protect your portfolio against further geopolitical supply shocks. Now I'm going to leave you with the critical black swan tail risk that the market is currently severely underpricing. Today, we're essentially relying on that 14.7% energy inflation figure acting as a ceiling. But what happens to these fragile asset pricing models if the Iran conflict dramatically escalates tomorrow? If that ceiling shatters, the resulting inflationary wave will completely force the Fed's hand, wiping out the bullish thesis entirely. Model that catastrophic impact into your portfolios tonight. Thank you for joining this explainer. Stay analytical, stay disciplined, and I'll see you next time.